So we undertook the survey because we felt we didn't understand enough about the investment objectives of broking advisors. There's survey data out there for institutional investors and retail investors, but nothing really from the broking community. So rather than assume, we thought we'd go and ask them what they're trying to do. And so what was clear from the survey results was they have three primary objectives for their client portfolios. The first is to maximise income. The second is to maximise total return for the portfolio. And the third is to protect client capital from drawdowns. It was surprising just how much growth assets they had in their portfolio. So from an asset allocation perspective, we think broadly about growth and defensive assets. Growth assets include domestic equities, international equities, property, hybrids. The average broker portfolio had about 80% exposure to growth assets, with the other 20% in things like unlisted and other securities such as options and warrants and so on. The surprise there was around the capital preservation objective that brokers have for their portfolios is potentially difficult to achieve with so much in growth assets. So that was the first surprise. The second surprise was that actually brokers look like they're already early adopters or strong adopters of managed listed vehicles. And what I mean by that is sort of passive ETFs, active ETFs, LICs. There was quite a strong indication that brokers were already using a lot of these ASX listed vehicles to construct these portfolios for their clients. And so whilst there might have been a perception that they're not using externally managed structures, that actually wasn't the case. So the growth portfolio has a similar set of objectives to what the brokers are trying to achieve. We don't really focus on income so much, but our objectives are around CPI plus 5% per annum total return, so it's sort of a growth objective. We try and keep volatility between sort of 3 and 7%, so call it around 5%. And like brokers, we try and protect capital. So the way we phrase that is minimise the incidence and magnitude of drawdowns. So we have similar objectives, but our view of the world at the moment is that assets are quite expensive, and so we're very defensively positioned. We probably have, well, we clearly have less in the growth asset bucket than the broker portfolios. We have more exposure to things like fixed income, bonds and diversifiers. And again, when we looked at the broker survey, they really had no exposure to fixed income. And we also have a very high allocation to cash, and that's probably reflective of our sort of concerns at the moment about market valuation and wanting to be defensive and to protect capital. So we've been running multi-asset portfolios in unlisted traditional managed fund form for many years. And so part of delivering the real return strategy in an ETF form through Grow was to give access to those investors who had a vast preference to buy ASX listed vehicles. So we've set the structure up so that it's easily accessible for brokers and all direct investors. The way it fits in their portfolios as from our perspective is as a diversifier. So without as many diversifiers in their portfolios at the moment, Grow gives them that diversification benefit. But Grow's not necessarily targeting a very defensive exposure all the time. We're defensive now because we're worried about markets, but we're still trying to achieve a CPI plus 5% growth objective. So we see the role of Grow in investors' portfolios as a diversifier and one that can be very active in its asset allocation, but not necessarily one that's always going to be defensively positioned. It will adapt to market environments. So hopefully, over the 3-year cycle, which is our sort of return horizon, we're delivering those returns consistent with a growth portfolio, but we're doing it in a very different way to the traditional sort of growth positioning in their portfolios. We think that brokers who have a very high exposure to growth assets could benefit quite a lot from having more diversification, and Grow in effect in one sort of easy to access listed structure gives them that diversification so that clients can allocate to Grow, improve the diversification of their portfolio, improve the sort of risk characteristics in terms of that drawdown, protecting capital part of their portfolio, and not necessarily give up on the return objective they have, because we have a CPI plus 5% return objective too. We want to grow capital. This is not just a very defensive portfolio all the time.